Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Happy Friday, everybody. I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. Every day, we also take a look at the Bloomberg Big Take story. It's a deep dive into some of the pressing financial, political, and economic issues of our time. You can check it out on the terminal or also Bloomberg.com/Big Take. And today, it's about banker bonuses. Wall Street bonuses often come in the form of restricted stock units. So how did that actually perform? It's dicey. It's unpredictable. Do you actually make money off of those things? Well, joining us now is one of the authors of the story, Laura Noonan, Bloomberg News finance reporter. Walk us through your story, Laura.
Thank you. So the story basically looked at the restricted shares over a period from the financial crisis in 2008. And the question we want to ask is, how does the number on the letter you get on bonus day compare to how much you actually get by the time those shares vest? So we assumed certain things. And what we showed was that in the case of the US banks, you usually end up making more. In the case of the European banks, you usually end up making less. And in some cases, the numbers were quite severe. So there was one case we looked at where the Bank of America people who got bonuses in 2011/2012, they ended up, if they had sold them as they could over a 3-year period, they would have got $270,000 for every $100,000 in the letter. So that's a big upside. Off the end of the spectrum, the Credit Suisse bankers who got bonuses towards the end of Credit Suisse's life would have seen the money effectively disappear when Credit Suisse collapsed in 2023.
Are we seeing investment banks pay more of the bonus in stock or RSUs, less cash, more? Is that a trend?
It's been a trend since the financial crisis, which is why we started the analysis there. So the idea was to align the risk-taking of the people who are making bonuses with the longer-term fate of the banks that they work for. Within the EU, there are rules about this, so you have to get a certain percentage of your bonus in these kind of restricted instruments, and the percentage that you get is higher depending on how senior you are. So it's certainly something that banks have been doing for risk management. They're also doing it in terms of retention, in terms of if you are a really strong bank and your share price is expected to appreciate and you want people to stay working for you, it makes sense to give them things which kind of align their fate with the fate of the bank because it makes them stay, which is what banks are trying to do, especially as they face more competition for staff from other industries like tech, like some of the non-listed banks and the private markets industry.
Paul's here shaking his head. He didn't like it.
I'm just going to keep my mouth shut here because I think about the Europeans and their pay structure.
And you don't like that, Paul? You're not a fan?
Ridiculous. That's why there's no global investment bank coming out of Europe. That's why there's no technology coming out of Europe.
I mean, it's a fair point.
Yeah, it's okay. It's okay.
I mean, Paul is a recovering former M&A media banker, so this is near and dear to his heart.
There are a lot of issues in European investment banks, and we will be telling you more about those in different stories. There are some unique structural issues around bank pay. Those do limit their capacity to attract some people. It's going to be really interesting in the UK market now because the UK has just rolled off some of those rules introduced in the EU. The UK obviously is outside the EU now. They are liberating things here. It's going to be a really interesting market to see how people respond in terms of, do people want to work for Deutsche Bank, BNP Paribas within the London operations now, or would they be even more likely to go to a Goldman Sachs, a JP Morgan, where you can now get really big bonuses?
Can I just ask about the whole Credit Suisse debacle there? Like, what happened to all of those bonuses and payouts, et cetera, when you take a look at Deutsche Bank and Credit Suisse?
So Deutsche Bank has just had a very troubled share price situation. I mean, if you look at the share price of Deutsche since the financial crisis, it has pretty much, it had a very, very sharp decline over that period. So, I knew people who had Deutsche bonuses and they were like, oh, this will be the best trade I've ever made because you get a lot of shares when your share price is low to get you to that dollar number, and they expected the share price to recover. The share price did not recover. It fell further and further and further. So they just had a very tough time share price wise. Credit Suisse was interesting because if you look back over the analysis, there were some years when actually Credit Suisse stock did really well, and that was because in the immediate aftermath of the crisis, kind of 10, 11, 12, Credit Suisse is actually very strong. Where it came crashing down to earth was in the more recent past when those shares effectively got zeroed by the collapse/takeover from UBS. There's a lot of nuance there. What I should also say is for this analysis, we looked at 12 banks, the 12 banks who most commonly give bonuses. However, we have a tool for the terminal users. You can go on that, you can click on it, you can enter any listed company in the world. You can enter any kind of vesting structure you might have, any dates, and you can see how your life would have been different if you got your bonus at a different bank or if you made different career choices when you were like 25, or how your colleagues down the road have done. So there is a lot of fun that you can have if you're into playing with Excel sheets. You're in for a fun weekend.
And I guess, you have some great stuff in here about how the best year for bank bonuses was 2012, because I guess, depressed values and the banks did well after that.
Share prices were not good. Yeah, so it's some parts of it are kind of counterintuitive, but the thing about depressed values is and it kind of goes without saying, but they have to recover. Yeah. So I've seen people make some pretty bad decisions thinking that things will always rebound to some kind of norm. And the one thing we've learned in European banks since the financial crisis is mean reversion hasn't really been a thing in the way people think it was going to be. Some business models turned out to be, structurally fatally flawed in the case of Credit Suisse. So you can't always assume that it's going to bounce back. Because, if you talk to the Credit Suisse bankers, you talk to the Lehman bankers, who it was a different era, but they also, and then I know a few people who work for both Lehman and Credit Suisse, and, the world's tiniest violin, they're still quite rich guys. However, they will be much richer guys in other places.
All right, Laura, thanks a lot. We're going to leave it there. Thank you very much, Laura Noonan, a Bloomberg News finance reporter, joining us on banker bonuses.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One stock on the move to the upside is Baker Hughes. It is the best performing stock in the energy sector within the S&P. Baker Hughes is an oil services company. It has two main lines. One is literally oil services. So if you're an oil driller, you call Baker to help you drill the oil. The other is industrial and energy technology. That's much more related to sort of the future of what the business will be. It encapsulates LNG export facilities, which they are a huge provider of. And this stock has crushed its competition. You look at a comp chart, Baker Hughes versus, say, Halliburton and SLB, they've crushed it over the last year. They reported earnings last night that beat very high estimates, and yet the stock is still up by about 6%. We're pleased to have the CEO, President, and Chairman Lorenzo Simonelli joining us now. Lorenzo, good to chat with you. I gave you a nice setup there. What do you think that you have that the peers don't?
Say that again, Alix.
What do you have that your other peers don't, in your best estimation?
Well, Alix, first of all, it's great to be with you and very pleased with the results of 2024. And I think it really talks to the portfolio and the capabilities of Baker Hughes. And as you mentioned, we have these two segments, one being oilfield services and equipment, and then the other being industrial and energy technology. And that capability of really being focused on where there's less cyclicality, less volatility. As you look at oil field services and equipment, we're much more on the production side weighted and looking at the mature asset solutions. And when you look at the industrial energy technology, really on the liquefaction side, the gas infrastructure, and also new energy. And again, we exceeded the guidance for new energy orders intake in 2024, looking for another robust 2025. And it really comes down to the differentiation in the portfolio. And we're really not just an oilfield services company, we're an industrial energy technology company. And we've created a portfolio that's unique within the space.
All right, Lorenzo, as I've been telling Alix, who is the true expert here in Bloomberg for energy, I have watched season 1 of Landman, so I now consider myself an oil and gas expert, just putting that in front of you there. Love to get your thoughts, Lorenzo, on the implications of this new administration coming up. How much of a change in policy do you and your peers expect out of a Trump administration?
We've seen administrations in the past and changes, and obviously we had Trump administration previously as well. As we look at the outlook, again, we think that a number of our customers and EMPs are going to continue to be disciplined, and we're seeing activity levels and production, at least in the US, slightly increasing. As we look at international, again, we see flattish year over year. But again, I think as we look at the macro side, it's over the course of the next few years and the next decade, an increasing demand for energy. And that means it's an all of the above strategy. It's going to be oil, gas, it's going to be more renewables. And we see a good outlook on the macro side for Baker Hughes in that environment.
He does talk about Landman like all the time. So to break that down a little bit, I was talking to Mike Wirth, CEO of Chevron, earlier, and basically his theme in the Permian is to produce more, but with less. So less CapEx. It feels like the read-through of that for the oil services business wouldn't be great for you guys. Walk me through what you're seeing from the big oil players.
Again, as I mentioned, the big oil players, they're going to take the opportunity of benefiting from the consolidation and the acreage that they're bringing on. And what Mike is mentioning is really the aspect of doing more with what you have. Mm-hmm. And that's why Baker Hughes is well suited, because we're more on the production side. And again, as you look at our portfolio, greater than 50% is associated with the production. That's the electrical submersible pumps, it's the chemicals, it's the ability to really take more out of the mature assets. And that's been a big focus of Baker Hughes over the course of the last few years. And so as the intensity continues to increase on doing more with less, it actually serves the aspect of our production side and focus that we have on the mature assets.
Yeah, I'm glad you brought that up, because that's kind of what Mike Wirth was saying too, that like the technology just gets so much better that you can actually continue to get more oil, lower the cycle costs, and lower the cycle time. Switching to your IET business, so industrials and energy, a technology business, that's where you house sort of your LNG export facilities. That's where the growth is going to come from. Your numbers for the first quarter and for all of this year are just trouncing estimates. Who's your big customer for this?
Well, we've got the large LNG players, obviously, within North America, and we're looking forward to a number of FIDs taking place in 2025. Overall, globally for LNG, again, we see 100 MTPA of new projects between 24 and 26 over the course of this year. You know, there's still about 80 MTPA to go internationally, as well as also in the US. But it's not just LNG. It's, when you look at gas infrastructure and the associated infrastructure around pipelines being required, compression to be able to move the molecule. The LNG players, Venture Global, which we announced yesterday as well. You've got Cheniere, but you've got the majors when you think of Qatar Gas, as well as ExxonMobil with the projects that they have. So we play across the portfolio with these key customers, but it's not just LNG. 70% of the addressable market opportunity for us in IET over the course of the next few years is outside of LNG, and that's a $140 billion opportunity.
Where is it outside of LNG, and do you anticipate any acquisitions to even beat that up even more?
We're benefiting from the fact that our equipment can be utilized in multiple end applications. So when you go onshore, offshore production, when you look at FPSOs, and we see a consistent theme of 7 to 9 FPSOs on an annual basis. When you look at pipeline infrastructure, you look at downstream, you need pumps, you need valves, you need reciprocating compressors, you need turbines, and increasingly, behind the meter solutions as well, distributed power generation. And we've got a line of industrial gas turbines, obviously below 150 megawatt. And when you think of the data center growth that's going to be taking place, it's a large opportunity for us as we go forward.
Does that mean that, Lorenzo, you're going to be able to play in the AI data center rush?
We already are playing in the aspect of providing behind-the-meter solutions and also distributed power generation with our Nova LT line. And as we're working with a number of hyperscalers, and AI is definitely a theme that we see growing and the need for data centers growing, and they're going to need short-term solutions for getting the power.
Before I let you go, because you know I'm going to ask it, you got those two huge business lines. Any theories or feelings about a spinoff?
There is a tremendous amount of synergies between the two. And what's great about Baker Hughes is that we can navigate with less cyclicality, less volatility, because it doesn't matter on the pace of the transition. We actually match with the capabilities of oilfield services and equipment and the industrial energy technology. And we actually link the value chain together. And as you think of subsurface knowledge with then being able to move the molecule and do something with the molecule from a compression standpoint, liquefaction, or moving it elsewhere, the two segments work hand in hand together. So we like the portfolio the way it is.
I knew you were going to say that one, Lorenzo. It's great to chat with you. I love catching up with you. Lorenzo Simonelli, President, Chairman, and CEO of Baker Hughes. That stock up over 6% today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
News came out today that surprised me, talking about the U.S. Justice Department blocking HPE's acquisition of Juniper Networks. What happened to the animal spirits of a Republican White House, Republican Congress pulling back on regulation? This one kind of threw me for a curve, so we went to the expert, Woo Jin Ho, Senior Technology Analyst for Bloomberg Intelligence. Woo, was this expected? What's going on here?
Hey, Paul. It wasn't expected. I think there were some rumblings going on earlier in the week that the DOJ may block the deal for anti-competitive reasons. And then when the deal was close to the finish line, rumor was next week, DOJ decided to step in.
What's the problem?
Well, it's all about Wi-Fi. And it's clear that HPE can't live without its Wi-Fi either. The combination of HPE and Juniper would create 20% Wi-Fi market share in the North America. And if you combine that with Cisco, it would have over 70%. So the DOJ is essentially saying that it would create an anti-competitive environment in the wireless LAN space.
Both stocks are kind of flat to a little bit up here today. So what's the market telling us here?
Well, the market is telling us from a Juniper standpoint, there might be we're getting closer to a valuation floor if HPE needs to walk away. What we did write this morning was that we think that there is a $9 to $10 billion valuation on a standalone Juniper. That gets us to about a $28 to $32 share price, slight discount to where it's trading right now. From an HPE standpoint, it's telling a different signal. One of the reasons why they wanted to acquire Juniper as a whole is for a margin perspective. So the stock is down about 10%, and some of the margin accretion related to Juniper might be falling off.
What could they do to save this deal? Is there anything that they could offer?
Yeah, so look, at the end of the day, there's one particular product that Juniper has called Mist, and that was automated the Wi-Fi functionality as well as delivered some AI functionality. HPE doesn't want to walk away from that, but if they walk away from that portion of the deal, that could possibly preserve the deal. But with Antonio trying to go through with the lawsuit, they really want Mist, and quite frankly, I think it's one of the crown jewels of the deal.
So, Wooj, I know you probably speak to Jen Rhee at Bloomberg Intelligence. She does all this antitrust stuff. How are you guys thinking about this? What are you telling your clients? Is this deal going to get done? Is it not going to get done? Are they going to walk away? What do you think is going to happen?
Yeah, I've been going back and forth with Jen, and what Jen is telling us as well as Bloomberg and Bloomberg clients is that the DOJ actually may have a strong case. Quite frankly, I think it's kind of a bunk from a DOJ standpoint. HPE is getting penalized for Cisco having 50% market share, right? And one of the arguments that the DOJ is making is that there might be an increase in price. But the historical trend has been HPE actually has been a price leader in terms of having lower price for their wireless LAN products versus whereas Cisco is a price is a price leader where they have the highest price. So, I don't know where it'll be, but if Jen Rhee says that DOJ has a case, HPE may need to find alternatives.
So let's pretend that DOJ does have a case. What's a plan B, or I guess what does Juniper and HPE look without a deal?
Yeah, so the way I look at it right now is that there actually is still a lot of synergies. Juniper has data center networking, data center as well as cloud routing. These are two areas that HPE does not have, and actually would fit well with HPE's portfolio. From a valuation standpoint, we think that the standalone Mist piece would be about $2.7 to $3.5 billion. If you back that out of the original $14 billion price, we're talking about a $10 to $11 billion deal, Juniper valuation ex Mist. So, it'll still work out, and there are still areas of synergies, but you are missing out about $1 billion plus in revenue if you carve out Mist.
Wooch, about 30 seconds left. What's your favorite name here in your space these days?
Ironically, it's HPE.
Okay. Oh, okay.
And the quick call.
AI. It's the AI story.
It's the AI.
I think they're going to start gaining some AI server momentum in the quarter.
All right, great stuff. Woo Jin Ho, Senior Technology Analyst for Bloomberg Intelligence, joining us via Zoom from Princeton, New Jersey. Appreciate that. So again, HPE, Juniper, DOJ blocking. Kind of surprised, I think, a lot of us who were expecting, these animal spirits from a regulatory standpoint to take over and be kind of the Wild West out there for M&A, but maybe not.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.